Paolo, we saw that Black-Litterman was the keynote earlier today, and he was holding a session, but I have read your book, and in your book you do reference the Black-Litterman model. Perhaps if you can mention how he influenced you as an expert in this area.
Well, I think that we need to divide the history of finance into three periods in the Western world. The 1950s up to the late 1970s, beginning of the 1980s, is a tale of simple world. That means mean variance, Markowitz. The markets are simple, the products are simple, there were not even fixed income indices at that time, so whatever optimal portfolios the clients would have invested into, they would have gained enough returns to retire with comfort 30 years after. So it's a world of symmetry. Everybody can buy the same optimal portfolio in the future frontier. Then after the financial deregulation, which occurs in the 1980s, markets became very complex, very volatile and very bumpy. You remember all of the evidences of the recent financial crisis. And the products became very complex. Derivatives, certificates, structured notes, subprime. So it's very difficult to come up with a portfolio strategy that survives in a very complex world. And that is the time of Black-Litterman portfolio optimization. So it's a time of views and subjective views, so that if you have a professional opinion, you can trade it and possibly generate alpha or extra return for yourself and for your customers. However, that world is gone as well. And that was showcased by the global financial crisis, because this asymmetry of information that was so large in this period might have been somehow traded with a certain laxity to benefit financial institutions against their customers. So regulation stepped up in 2007, 2009, 2010. And regulators are wanting the financial institutions to be more transparent in front of their customers. So we move from a period of symmetry, Markowitz, through a period of asymmetry and views, which is Black-Litterman, into a period of transparency. So this requires, again, a change in quantitative methods, because the world today needs to be more transparent, though financial markets are complex, and products are still complex, even though they are simplifying little by little, you know. Every day is the fight between active versus passive investment management, for example. So that requires goal-based investing, which is a new way of looking at the financial problem to make financial decisions in terms of personal wealth or institutional investments.